So before we jump into today's video, I wanted to let you all know that I listened to the comments and I went and purchased a microphone. This is my first video using it, and so I hope that it provides some better audio quality than just my phone's microphone that I was using in previous videos. But with that out of the way, I want to jump straight into today's content. We're going to be doing a deep dive on the collapse of the insurance market in the United States. And to do so, we're actually going to be starting where I grew up and where I lived before I came to Texas during high school. So in 2023, State Farm canceled 72,000 insurance policies in California. And among those that had their coverage canceled were 30,000 homes in the Pacific Palisades, which is one of the most affluent zip codes in the country. And if we fast forward to January 2025, the Palisades fire burned through that neighborhood. Thousands of those homeowners had no coverage, and the fire became the costliest wildfire in California's history. Insurers paid out more than $20 billion in claims statewide. State Farm alone paid over $5.5 billion. And what's crazy is that these claims are still being sorted through. State Farm themselves actually put out an analysis stating that they expect their total liability to reach over $7.5 billion. And that sweet sequence of events, mass cancellations followed by catastrophic loss, which then gets followed by large insurance payouts, tells you exactly what you need to know about what is happening to the American homeowners insurance market. Private insurers are retreating from the entire state, and programs designed to catch the people that they leave behind are buckling under the weight. Home values in high-risk areas are declining, and mortgage lenders are flagging insurance, or really the lack thereof insurance, as a major systemic threat. And as a matter of fact, Jerome Powell, the former chairman of the Federal Reserve, told Congress in a February 2025 hearing that if we are to fast forward 10 to 15 years, there will be regions of the country where it is just impossible to get a mortgage. So today we're going to follow the data on the insurance market collapse. We're going to go over who it's hitting, what it is doing to property values, and the mortgage system. And then also why the private market cannot solve it alone, and then what the future looks like from here. So I gave you guys one specific story. Well, let's establish the true scale of what has happened and what's currently happening. In California, 7 of the state's 12 largest homeowners insurers have paused or restricted new policies in just the last 2 years. State Farm, which is the largest insurer in the state, stopped writing new homeowners policies back in May of 2023. And this move was then followed by Allstate, and then next came Farmers. And this continued until the California Fair Plan, which is the state's insurer of last resort, saw its policy count increase by 43% between September 2024 and December 2025. And as of 2026, the California Fair Plan has reached over 668,000 policies. It wasn't designed for this. It was built as a temporary safety net for the small number of homeowners in areas of extreme risk who just couldn't find coverage anywhere else. And the coverage that it provides is very limited. It only protects against fire perils, it also offers lower limits than standard policies, and it has higher premiums. The way I see the FAIR plan is that it's the insurance equivalent of an emergency room. It works well in specific situations, but it's just not adequate as a primary care system for hundreds of thousands of households. And California is not the only one dealing with this. Florida is going through a very similar story. At the peak of its insurance crisis back in 2022, carriers including Farmers, AAA, United Property and Lighthouse, and FedNat all exited. Citizens Property Insurance, which is Florida's version of the FAIR Plan, reached a peak of 1.5 million policies in 2023, which, like in California, is far more than it was designed to hold. And Florida's had a partial recovery that's worth acknowledging because it matters for what comes next. Legislative reforms in 2022 and 2023 that targeted insurance litigation abuse produced some significant results. By early 2026, 17 new carriers had entered the Florida market. Citizens Property Insurance shed over 1 million policies and dropped to approximately 395,000, which is the lowest since 2012. These reforms have caused rates to decrease across the state and has at least brought some stability back to the state insurance market. The catch with this recovery, though, is that Florida's stabilization was achieved through regulatory reform that reduced consumer protections by making it harder to sue insurers over denied claims. Critics of these reforms have argued that policyholders have traded market stability for a market where their claims are less likely to be paid in full. And that trade off has not yet been tested at a large scale by another major hurricane season. California and Florida, they've always been the major points of discussion for most insurance policy debates, but the crisis is not just limited to these two states. Damage from severe storms, whether it be tornadoes, hail, or high winds, have caused more than $51 billion in insured losses in 2025, which is the third consecutive year above $50 billion. States across the Midwest and the Southeast that were previously considered low risk are now seeing significant insurance carrier pullbacks as well as premium increases. Nebraska, Louisiana, Oklahoma, and Kansas, to name a few, are among the most expensive states for homeowners insurance, with average premiums exceeding $4,400 annually. So, what does this look like for the actual people that are being told that they're uninsurable? Behind every policy cancellation is someone receiving a letter telling them that the company that they had paid premiums to for years, if not decades, would no longer cover their home. And in most cases, these are not people who have made risky decisions. They did not build in a flood zone on purpose. They did not purchase property in a wildfire corridor seeking cheap land. They bought homes in communities that, at the time of purchase, were insurable at reasonable rates. The risk landscape around them is what shifted, and in response to this shift, insurance carriers at large are just leaving. Nearly half of all home buyers and sellers in a 2026 survey reported encountering issues with home insurance during a home purchase transaction. 21% of those surveyed reported that their transaction actually fell through entirely because of that insurance problem. For example, in Louisiana, from what I have found from a few different sources, is that about 30 to 40% of mortgage loans are failing because home insurance costs have pushed monthly payments beyond what the borrower can afford. And for those that don't know, a mortgage requires insurance. If insurance is unavailable or unaffordable, then the mortgage cannot close. If the mortgage can't close, then the home can't be sold. And guess what? If the home can't be sold, the homeowner is trapped, and of course, the would be home buyer doesn't get the opportunity to start that new phase of their life. Something that I found interesting, and it's pretty intuitive when you think about it, was that the Federal Reserve Bank of Dallas published some research finding that a borrower is more likely to become delinquent on their mortgage in the months following an increase on their homeowner's insurance premium. This is how an insurance crisis morphs into a mortgage crisis. The people hit hardest are not the wealthy homeowners in the most exposed locations because they can self insure. They can absorb the higher premiums or they can absorb a loss. The people hit hardest are low and middle income households. These are households in which their home represents the majority of their net worth, and the wealth that they have been building is quietly eroding. To understand why the insurance crisis is a financial system problem as a whole and not just an inconvenience for consumers, we need to understand the relationship between insurance and mortgages. And we touched on this earlier, but when a bank issues a mortgage, it requires homeowners insurance as a condition to take on the loan. This is not something that is optional, and they require it because the insurance is protecting the bank's collateral. To be blunt with you guys, the bank does not care about you. They care about protecting the asset in case you are unable to pay so that they can seize it from you. This means that every mortgage in a high risk zip code carries large insurance risk. If the insurance market retreats from that zip code and coverage becomes unavailable, unaffordable, or the coverage quality is so poor to the point where claims are routinely denied, then the bank's entire mortgage book in that area is exposed. Elevated insurance costs are directly affecting borrowers' debt to income ratios, which is an important data point that banks look at, leading to delays in closings and in some cases preventing borrowers from qualifying for a loan at all. Economists from Wharton and the University of Wisconsin-Madison recently published a proposal back in March of 2026 arguing that the dysfunction in the insurance market has reached a point where the private market alone cannot solve it. And the solution that they proposed is drastic. They proposed that a federal entity called US Re would sell reinsurance to the insurers of homeowners for catastrophic weather events. The fact that three mainstream academic economists from elite institutions are proposing a new federal backstop for the reinsurance market tells us just how serious the problem facing the country is right now. There is something important to understand about what insurers are actually doing when they exit a market or when they raise premiums. They're not making a political statement and they're not trying to punish consumers. They are doing what insurance companies exist to do, which is to price risk. And as unfortunate as it is, the only thing that these companies care about is profit. And the moves they make are done to make as much of a profit as possible, regardless of the consequences to consumers. And I hate that that is the case, but I'm just trying to be real with you guys. And the risk facing these insurance companies has changed rapidly. The number of acres burned in California has been increasing for years, and more people have moved into areas that when a fire occurs, more structures are destroyed. The January 2025 Los Angeles fires killed 29 people and forced over 70,000 to evacuate, as well as destroying more than 12,000 structures. This has led to insurance payouts in the tens of billions, as we have discussed, and the insurance companies are looking at this situation and looking into the future and thinking to themselves, why stay here? So let's touch on reinsurance real quick because it's something that I mentioned. Reinsurance is the insurance that insurance companies buy in order to cover their own losses. And just to give you guys an example, reinsurance costs make up around 40% of a Florida homeowner's premium. And when reinsurance becomes more expensive or unavailable, primary insurers face a choice. They either have to raise premiums, restrict coverage, or exit from that market entirely. California's regulatory environment has made the third option, which is to exit, the most rational choice for most carriers. Under Proposition 103, rate increases require regulatory approval and can take more than a year to secure. In a market where climate losses are happening faster than the regulatory timeline allows, economics of staying becomes harmful for business. State Farm's own internal analysis concluded that rate increases alone would likely not be enough to restore its financial strength in California. And so exiting was really the financially smart decision. The reform path that California has begun, which includes allowing insurers to factor climate change into pricing, to pass through reinsurance costs to consumers, and in exchange, requiring them to write more policies in high-risk areas, is an acknowledgement that Proposition 103's framework was designed for a different risk environment. Basically, the bargain was, we will control your rates, in exchange you will provide coverage. And even so, that bargain broke when the losses exceeded what even the increased rates could cover. In high-risk areas, the cost and availability of home insurance are beginning to influence home values and suppress demand. This is a demand-side shock to housing markets that operates independently of interest rates, labor markets, or broader economic conditions. A neighborhood can be thriving economically, with full employment and growing incomes, but still see property values decline if the insurance market has withdrawn. And for the households that are affected, this represents a destruction of net worth that is occurring silently, without a market crash, without a recession, and without a catalyst that would trigger the needed policy response. The homeowner who paid $600,000 for a house in 2019 is now watching it appraise at $556,000 while also paying $8,000 a year for coverage that would have cost $2,000 5 years ago. They are experiencing a real financial loss that goes completely under the radar, and unfortunately, it's likely to continue. Housing represents the largest piece of household wealth for the majority of American families. And if the insurance crisis continues to erode property values in high-risk areas, and the high-risk areas continue to expand, the negative effect on consumer spending and financial security could be significant. And the worst part is that it's already happening. So let's take a step back and look at the full picture. The American homeowners insurance market is undergoing a major transformation that is being driven by three forces: climate risk, that is compounding faster than actuarial models anticipated, a regulatory environment that prevents insurers from pricing that risk accurately, and a reinsurance market that has been repriced sharply upward. And the result is an insurance market that's in retreat. As I mentioned, in California, 7 of the 12 largest carriers have pulled back. The FAIR Plan is holding hundreds of thousands of policies that it was not built to hold. In Florida, a legislative intervention stabilized the market, but at the cost of reduced consumer protections, which we won't know the effect of until the next major hurricane. And this crisis is expanding into the Midwest and the Southeast and is likely to expand even further. The insurance market is not broken because of bad management or financial misengineering. It is repricing risk that was previously underpriced, and this has been in response to a risk environment that has changed dramatically. And while this is the case, let's not forget what motivates these changes from the company's point of view, which is maximizing profit. The question going forward is not whether the private insurance market will return to the coverage scale and the prices of 2015. That just isn't going to happen. The question then is what gets built to fill this gap? And how much wealth destruction is going to occur in the regions where the insurance market has retreated while that infrastructure is designed and debated? So that's going to do it for today's video, guys. It's not exactly a fun topic to discuss because of the negative impacts it has on my fellow Americans. And while it's disheartening, it's important to know and to talk about. So if you guys found this video interesting, please drop a like, subscribe to the channel, and check out my other videos. As always, let me know what your thoughts are in the comments. I'm curious to hear from those of you that have been impacted by these changes in the insurance market. Tell me about the insurance experiences you guys have had in recent years. I've had many friends and family members impacted in California, so I want to hear your stories as well. Thank you for watching and for all the support on my videos. Have a great rest of your day, and I will see you in the next one.